Welcome back. Looking fairly strong for the market. Let's address some more earnings that came by yesterday. We do have with us management of Brigade Hotel Ventures joining in. Nirupa Shankar joins in to decode their earnings. Nirupa, obviously the fourth quarter was impacted by a high base, and then the West Asia crisis played its part as well. So the reported numbers, ex of other income, your revenues grew just a little over 1.5%. The EBITDA ex other income as well was lower year on year. The question I'm asking is, what was the impact of the West Asia Gulf crisis? Because a lot of remittances come to the areas where you operate your hotels. Was there any impact on account of that? And in light of that, what are you projecting for FY27?
Hi, good morning, Mangalam. Good to see you. Yes, we actually had a pretty good year. We managed to hit most of our targets, and we got very close to hitting our EBITDA targets as well. Overall, for the year, we saw a very good increase in the overall revenue by about 15%. EBITDA also grew by 15%. Our ADRs grew by about 11%. And of course, our occupancy stayed somewhat stable. But overall, I would say that we performed well, and it was as per market expectations. Specifically in terms of the West Asia crisis, yes, there was most definitely an impact. For instance, in Q4, we had almost 7 to 8 crores worth of cancellations, which was about 5% of the overall business. And what happened is basically while we were able to sort of replace that overseas business with domestic business and domestic MICE, there was definitely an impact in terms of the F&B revenues that we saw. However, despite the lowered F&B revenues that we expected, we were able to increase our ADR. Our ADR grew by about 8%, and our average for the quarter was more than 8,000 rupees, which was higher than the overall year. And we also managed to increase our overall Q-on-Q revenue by about 8%. So yes, it did impact our business. And I would say even the next 3 months, we have seen a little bit of a slowdown in the kind of bookings and the pickups that we normally see. So if you ask me, we lost about 7 to 8 crores in Q4, and then we are expecting that to also hit in April, May, and June. Maybe about another 7 to 8 crores in the coming quarter.
7 to 8 crores in the coming quarter, 7 to 8 crores in the previous quarter, but you're making up that with the domestic demand. And that's where the question is. For FY27 on the whole, what's your target with newer rooms coming in as well, slightly higher ADRs? What are you looking at in terms of occupancy, revenue, and margins for FY27?
Yes. So for FY27, we will be adding a smaller hotel. It's a Courtyard by Marriott as part of our mixed-use development, the World Trade Center in Chennai. So that should come somewhere in the second half of the year. We're also keenly looking at new acquisitions. We haven't yet finalized on anything just yet, but we're very keen to do at least one inorganic acquisition this year. But, of course, with hospitality, you have to look at quite a few and reject many of them before you select any one. So we're being very careful about the new acquisition, but it is definitely something that we're looking at. In terms of increase in revenue and EBITDA targets, I would say that we are looking at a mid-teen kind of a growth when it comes to revenue and EBITDA. But I'm happy to say that our quarterly EBITDA for Q4 actually hit closer to 40%. It was 39.7%. While the overall for the year was trending closer to 36%, I'm happy that we were able to increase our profitability to about 39%. So ideally, we would eventually want the portfolio to have an average of closer to 40%, at least in the next 2 years. But of course, that will very much depend on the ADR that we're able to command. And I'm again happy to say that our hotels have at least hit, while the average is around 7,500, Q4 hit about 8,000. So despite all the geopolitical issues and macro environment issues, we're still able to get that ADR growth, get that revenue increase, and get that EBITDA growth.
All right. Nirupa, hi, good morning. Good to see you, Win. Give us a sneak peek into that inorganic opportunity that you're looking at. We don't know the name, we don't know the exact details, but a broad sense will be helpful, right? What is the potential size that you're looking at? If you could help us out with that. And also lay out your CapEx plan, X of this inorganic growth. What is the CapEx plan you have for this year and the next?
Yeah. So this inorganic growth was also part of our IPO proceeds. We had set aside about 90 to 100 odd crores. So we will have to find something. We would like to find something that's ready to operate and not a greenfield. But like I said, we're in the business development process, nothing yet finalized, but that's something that I'm very keen to do in the coming year. In terms of the capex that we have, like I said, today we have 9 hotels. The growth plan is for another 9 to come up, apart from the 45 key hotel that we've mentioned and apart from this inorganic growth that I mentioned. So the capex that we're looking to expend is about 3,400 crores, of which we expect at least 2,000 to 2,200 crores to come from debt. The balance will be through the through internal accruals that we will garner over the next 5 years, and of course some amount of the IPO proceeds. Now our debt is high. We don't have much debt apart from a 140 crore loan to the parent company, so we do have the ability to scale up our debt in the years ahead.
Right. Increasingly, there's this trend of a lot of private equity players coming in and entering the hotel business. They either buy assets and let the hotel owners run the company. But in your case, you guys are asset owners as well. Any talks with any sort of private equity players to unlock some sort of value in some part of your portfolio?
No, not yet. I think right now we have the funds to sort of scale up with our existing portfolio. Like I said, while our debt might go a little higher in 1 or 2 years, the important thing is that we will be able to cover all this debt and we'll be able to fund our own growth through our internal accruals and some debt. We do have one of the lowest cost of borrowings in the country, so that should help us make the project feasibility a lot better.
Okay, all right, Nirupa, thanks a lot for joining in. Wishing you and the entire team all the very best for FY27, and we'll keep catching up and getting an update.
Thank you so much, Nigel. Good talking to you as well. Bye-bye.
All right, well, time to slip into a short break. You come